Hello, hi, I'm Nick Burgess. I'm a quant analyst. I work in financial services and I specialize in electronic rates trading and credit markets. Today, I'm going to give you an overview of quant models for pricing and risk. What I'm going to do is I'm going to share the screen. I'm going to take you through theory. So, I'm going to show you a couple of slides on the theory of how that works. And then I'm going to show you after that a second part, which will be looking at Excel spreadsheets on how those models work in live sort of real practice. Okay, so without further ado, let's jump onto the screen. I'll share my screen. I'll show you how this stuff works. Give me 1 second. There we go. What I'm showing here, Alex, I'll run the slideshow. So what we're seeing here, some slides here, an overview of quant models for pricing and risk. Like I said, the first part I'm going to show you is the theory. And then the second part, I'm going to show you the pricing and the practice. Everything I share I'll share the links to in the YouTube channel, and please subscribe. That'd be really helpful. Okay, let's jump in. So part one, I'm going to give you an overview of what quant models are and what they do. Part two, I'll show you the pricing and practice. So quant models, what are they? What do they do? For pricing and risk purposes, what we want to do is we want to, given a set of market data, um, given a set of market prices, rather, we want to sort of extract the market data used to price those products. So it's working out and extracting market data from market prices. Now, what we'll find is that when we extract market data from market prices, you only get the data for certain points, certain time points. And so we have to fill in the gaps using interpolation, extrapolation. Now, the other thing we have to do is that when we're selecting the data to imply from market prices, sometimes there's more than one type of data, and we have to select the data we're solving for, and that's called the state variable. And then the last thing I'm going to sort of talk about is the infrastructure and tools needed to build your own models. Now, in the second part, I'm going to give you an example of how we calibrate an interest rate yield curve for US dollar SOFR. And I'm going to show you how to calibrate a credit model to US Treasury bonds. And we're going to use the market data from the yield curve and the credit model to price a CDS, which is a credit default swap. Now, for more information on for my research papers, there's a link here to SSRN where you can find my working papers. If you want more information on interest rate markets and credit default swaps, I've written a book on this subject, and the link to that is here as well. So let's move on. So a model overview for buy-side models for pricing and risk. So what do the quant models do? What is their purpose? What are they and what do they do? So like I said, given a set of market prices for a set of liquid instruments, we imply a full market data term structure. Okay, that's a bit of a mouthful. What do I mean by that? So what we do is we look in the interest rate markets, for example, we would look for instruments that are very liquid, instruments that are not stale, that are actively trading, and we want to take those instruments and create a small collection, say for example US dollar swaps, and then we're going to sort of then try and work out what are the forward rates and discount factors for those instruments. We're typically going to get a finite set of points. We're going to get market data on maybe the 1 year point, the 5 year, the 10 year. We're not going to get all market data, but we need market data on for all time points. And that's what I mean by full market data term structure. We want to know what is the market data on every point, every time point. And once we know the market data for a handful of points, we can fill in the gaps using interpolation. So here's a chart sort of with an example here. So for US dollar SOFR, for example, I'm using arbitrary data here, but given a set of par rates or given a set of market data for interest rate swaps, we can work out what are the forward rates on certain time points. So maybe here, like the 1 week, you can see I'm doing monthly out to 1 year. And then after that, and I'll show you a live example of this. So I'm getting the data points, market data points for certain time points, but not all time points. And I'm using interpolation to fill the gaps. Here, I think I'm using linear interpolation on this particular example. So this is more of a toy example. But basically, given an input, so you get market prices are an input to the model, and the model will then solve and give you as output the market data on all points. So some examples here. So if I give an interest rate model some US dollar SOFR swaps as input, and when I say swaps, I mean the instrument definition and the price. um, then the output will come back as I'll be able to get forward rates and discount factors on any time point. So if I want to know the US dollar forward rate in 1 year's time, 2 years' time, 3 years' time, it'll just tell me what those forward rates are, and I need that information for when I'm pricing interest rate swaps, and likewise I'll also need discount factors. So the US dollar SOFR the US dollar yield curve model will give me back forward rates and discount factors, but I had to give it US dollar SOFR swap prices as an input. Now, the second example is for CDSs. So in the credit world, so if I want to sort of price a CDS on US dollar Treasury, for example, you would the model that I would need, the credit model I would need would be I would need to provide that credit model with CDS spreads for US dollar Treasuries, and that would be my input, and my output would be hazard rates and default probabilities. So I can work out what's the probability of receiving my cash flows on my CDS. So that's the credit model. So two different models, two different outputs. So the yield curve, so US dollar SOFR yield curve would give me back interest rate forwards and discount factors, and then a credit model would give me back hazard rates and default probabilities for credit product pricing. Now, so what we're saying is you give the model market data, you give the model market prices, and you get back implied market data. And that market data, then using that market data, you should be able to reprice those instruments that you gave as input. Now, the infrastructure needed to build your own models. You need pricing analytics. You need to be able to price the instruments that you want to use to calibrate to. So the prices you're going to give me as input to the model, I need to be able to price those instruments. So you need pricing analytics. Now, the second thing you're going to need is you're going to need an interpolation method, because you're not going to get back after you're going to work out the market data for the instruments that you're providing. But we want to know the market data for all time points. And so we need to be able to fill in the gaps. And for that, we need an interpolation method. Common methods are going to be splines. You may also see linear being used, or even flat interpolation and extrapolation being used in some models. We typically want the interpolation function to be something smooth, something arbitrage free. We don't generally want it to have kinks in that data, because that will generally imply that you've got some kind of arbitrage opportunity when you're looking at the model output. Now, the other infrastructure we're going to need a solver. So, and that's the sort of the heart of the model. So, given prices, we're going to need to solve for the market data to price those instruments that you gave as input. And we need a multi-dimensional solver, which means we're solving for more than one thing at a time. So we've got multiple instruments. We need to solve for multiple. So we need to solve for multiple market data points. Now, a very common sort of solver you see being used is Newton-Raphson technique. And generally, there are many other sort of solvers, but this is a common one. It's a fairly sort of straightforward one as well. And one of the reasons why people use things like Newton-Raphson, or why gradient, which is a gradient descent type solver, is that some solvers, which at least the gradient descent flavor of these solvers, what they will do is they'll work out the slope of the function, and they'll use the slope of the underlying functions, in this case your market data sort of formula, to solve for the market data. And because it's using the slope is and it's typically the first order derivative, first order gradient. That slope, that gradient, is going to give you first order risk. And it's stored in a matrix format called a Jacobian. And so if you're solving for SOFR swap par rates, the gradient is typically going to give you the DV01, and likewise, for credit models, the gradient's going to typically going to be able to give you the CSO1. So using these slopes, using this extra information which is embedded inside your model, if you keep the Jacobian matrix stored in your model, it's extremely helpful, because that information can be used to compute ultra-fast DV1 calculations and ultra-fast credit spread CSO1 calculations. And so basically all your risk calculations on a portfolio level, including all your hedges, can be calculated in real time if you keep that Jacobian information. It's exceptionally useful, exceptionally important and useful information. So sometimes choosing to work with a gradient descent solver gives you the ability to compute real-time analytical risk on a portfolio level, and that'll all be in real time with hedges. So it's exceptionally important if you So the choice to solve is very important. And ideally, we want to have something with a gradient descent. So the infrastructure needed is you need to be able to price your instruments, you need to be able to interpolate, you need to have a solver. And if you can have a gradient descent solver, that's actually helpful for risk calculations. So that's a basic overview of what models do. So we're saying we're taking, so we give market prices to our model, we get back market data, and we use interpolation to fill in all the points. So you can get back market data on every time point. So basically, you get back a curve. In this case, we've seen a curve of instantaneous forward rates for a yield curve, and then for CDS pricing, you're going to get back, and it's a similar sort of looking curve, but it'll have hazard rates, which are used for default probability calculations. But this is a similar pattern which you'll see for all models, including volatility models. Now, if you have any further questions, please do follow me and please do subscribe to my LinkedIn channel. Now we're going to go to the second section, which is the practice, and to give you an overview of what this looks like in real life. So let's jump into an Excel spreadsheet where I've got an example of this up and running. So what I've got here is this is a yield curve model, and what I've defined inside the model, I've got a definition of the instruments being used for calibration. So we've defined inside the model what the OAS instruments are, or the SOFR swaps, what the date schedules are being used, and the product definitions are inside the model. We provide to the model what the market sort of par spreads are for these interest rate products, for these SOFR swaps. And if I refresh this, you can see it's sort of there's a calibration time here, and it's sort of calibrating in around 6 milliseconds, 7 milliseconds. So it's exceptionally fast. You can't even tell it's refreshing, to be honest, sometimes. And you can sort of see here from the calibration time as I sort of refresh using Shift F9, you'll see this is calibrating exceptionally fast. Now, interest rate models in electronic markets, they need to typically calibrate. You really want them to calibrate in nanoseconds, and a very modest implementation like the one I have here would be sort of around sort of 10 milliseconds, maybe this one's 6 to 8 milliseconds typically. But we're really looking for that's typical, very modest performance for electronic markets. So we typically need the calibration to be very quick. So here I passed in bar rates, calibrated very quickly, and then inside this curve, then it's basically an interpolation function which will give me access to forward rates and discount factors for any time point that I want to request it for. Now, here's a credit model as well. So doing the same thing, see a little bit more information on this one. I have a choice to calibrate CDSs or to bonds. We can work out sort of probabilities of default from CDSs or from bonds. So I have a choice of instrument here. So when I calibrate the CDSs, my CDSs are going to reprice. When I calibrate the bonds, my bonds are going to reprice. So you can sort of see here, it's calibrating again pretty quickly. It's difficult to see it calibrating because it's so fast. But when I'm calibrating the CDSs, my bonds don't reprice. So the reds are the prices I would get from Bloomberg, and the greens are the prices I'm getting from my model. If I switch to bonds, you see me sort of repricing my bonds. You see now these match. If I switch to CDSs, then the other ones match. Then my CDSs will match. Now, one of the things people always do when traders will do whenever they have a model for pricing of risk is that the first thing they do is they'll check, can they reprice all of their calibration instruments? So here's me sort of checking here, do I get the same par spreads when I price the products, the same products that were inputs? And you can sort of see there's no difference, it's exact pricing, and that's what you expect. And so you can see my CDSs are repricing when I price the CDSs, and when I price the bonds, my bonds reprice. So you have to, in this particular case, we have to pick, are we going to calibrate the bonds or CDSs? And generally, you're going to pick calibration to match the most liquid instrument, or you could sometimes people also pick the instruments that they want to price. If you want to sort of price bonds, you calibrate the bonds, and if you want to price CDSs, you calibrate the CDSs. If you want to price something else that's not a CDS or a bond, you pick the most liquid. So I typically would calibrate the CDSs because it kind of depends on what's available as well. So sometimes you don't have bonds, liquid bonds trading, and sometimes you don't have liquid CDSs. So it just really depends on the underlying. You can see here in the credit markets, it's quite common to use piecewise constant just because there's not many data points. So in this particular case, we used all the treasuries. You tend to have lots of points. You typically see in the credit markets people using linear or piecewise constant, but piecewise constant is exceptionally common because quite often you'll just have a single point, which is the 5-year point, being the only liquid instrument. So it's quite common practice to use piecewise constant, which just means flat. It means So that's quite a common choice. So what have we done here so far? I've taken par rates from SOFR swaps, so interest rate swaps in the market, and when we worked that, the model sort of worked out what are the forward rates and what are the discount factors that correspond that will reproduce those prices. And then likewise here in the credit model, we've taken CDS par spreads in the market and we've worked out what are the hazard rates, what probability of default are being assumed to price. What are those values that will reprice my CDS swap and give me these par spreads? So the interest rate model is working out interest rates, forward rates, and discount factors, and the credit model is working out hazard rates, which is given the choice of market data we provided. Now, if I want to price a CDS, I've got a definition of that inside this object here. So I define a CDS, all the static data is inside this object, and then I just provide some of the trade information here. So I'm saying I want to pay the premium. It's $10 million notional, starting today, or starting in 5 days' time, and for 5 years. And I've put in here, this is the premium that I want to pay on this trade. And then if I press Shift F9, I get back all of this information. I get back my prices here, and I get back the cash flow information here. Let's change something so we can sort of see it moving. So you can sort of see this is a 2 year. I want maybe a 1 year. And you see my par spread is sort of changing. I go back to 5 year. I'm getting back here. Then this is I've put in the par rate in this case. So this is a calibration point. I'm saying the 5 year is has a credit spread of 0.2489. And if you look inside your credit model, I see that's what I've calibrated, 0.2489. You see but when I put in that as a par spread, you see its prices to zero. So I'm showing that I'm repricing back exactly. If I change this par spread to something else, obviously I'm not pricing at par anymore. Par being sort of the break even rate. So I'll leave it on the par rate. So that's a par instrument, and I'm able to price this now because to be able to price a CDS, I do need to know the discount factors. I need the discount factor information, and I need the probability default information, and that's why I need an interest rate model and a credit model for a CDS. So here, repricing a calibration instrument is pricing back perfectly. Now on this page, I'm pricing back just a bespoke CDS, which isn't a calibration instrument, and you can and that's the purpose of the credit models. It's not so much that we can reprice the instruments that we already know. We know 5 year instruments are quoting in the market. We can just read the price off the screen. But as soon as you want to sort of change your trade in any way, or as soon as you want to price price a CDS that's not 5 years, so maybe tomorrow when it's 4 years and 364 days, it's no longer a calibration instrument anymore, and you still need to price your products. So you need your models for those. Obviously, if you're pricing pillar points or you're pricing liquid instruments, you could just look at the Bloomberg screens and just read off the prices. But as soon as you want to do something bespoke, or as soon as it's not a calibration instrument anymore, you will need a model. And that's what we've achieved here. We've created an interest rate curve. We used SOFR to get forwards and discount factors. We've got a credit model which gives us the probability default and the hazard rates, and then we checked that that we can reprice our CDSs using that market data, and then we're able to price any kind of bespoke CDS that we want, and work out the price. So we have market data. So the models basically you take prices that you see of liquid instruments trading in the market, you work out market data for all data points, and then you can price any instrument, not just the instruments that you see quoting on the screen. So you can do bespoke instrument pricing and also risk. I didn't show you the risk too much here. I mean, I've got CSO1s that are quoting, but we'll look at risk in a different session. So I hope that's been really helpful. If you have any further questions, do follow me on LinkedIn. Do subscribe to my channel. I hope you've enjoyed the session on what quant models are and how to set them up and the infrastructure needed. And thank you so much for your time. Thank you. Bye.